Picture this. You walk into a boardroom full of Wall Street executives, and they start throwing around terms like beta coefficients and market capitalization metrics. Your eyes glaze over, you nod politely, and you walk away feeling like you just got excluded from a secret society. Here's what they don't tell you. That confusion isn't an accident. The financial world has created this barrier of complicated language, not because investing is actually that hard, but because confused people don't ask for their fair share of the profits. I spent my first year thinking a P/E ratio was some kind of gym equipment. Seriously. And while I was sitting on the sidelines feeling intimidated by fancy terminology, people who understood these simple concepts were building generational wealth. That ends today. We're about to steal their decoder ring and learn the language that separates the wealthy from everyone else. By the end of this, you'll not only understand what they're talking about, you'll be able to spot the same money-making opportunities they look for every single day.
Bull market, bear market, and volume. The bull market when everyone's getting rich. Picture a massive bull in a china shop, except instead of breaking everything, it's making everyone money. A bull attacks by thrusting its horns upward, and that's exactly what happens to stock prices in a bull market. They charge relentlessly higher. I lived through the greatest bull market in history, from 2009 to 2020. 11 straight years where the market didn't just go up, it absolutely exploded by over 300%. People were buying houses with their stock gains, quitting jobs they hated, and feeling like financial geniuses. But here's the thing about bull markets that nobody talks about. They make everyone feel invincible right before they get humbled. I watched friends who'd been investing for 6 months start giving advice like they were Warren Buffett. The music always stops. And when it does, overconfident investors get caught dancing. We're talking about prices consistently rising, typically 20% or more from their lows. Bull markets are fueled by optimism, low unemployment, and strong corporate earnings. But here's the kicker. A smart investor knows that overconfidence is a bull market's biggest trap.
The bear market, plus volume, when fear rules everything. Now imagine that same bull, except it's been replaced by a massive grizzly bear swiping its claws downward. That's a bear market, when prices fall at least 20% from their highs and fear spreads like wildfire. The 2008 financial crisis was a perfect example. People lost homes, retirement accounts got cut in half, and everyone was convinced the world was ending. I remember my dad checking his 401k daily, watching decades of savings evaporate. But here's the secret that separates the wealthy from everyone else. Bear markets are where fortunes are actually made. While everyone else is panic selling their best companies at basement prices, smart investors are backing up the truck and buying everything they can afford. Now, let's look at the crowd for that wrestling match. That's volume. Volume measures how many shares of a stock change hands during a specific period. High volume means lots of excitement or panic and suggests strong conviction behind price moves. Low volume might indicate a lack of interest or uncertainty. Volume spikes around earnings or major news can signal that informed investors are making big moves. Market capitalization, price-to-earnings ratio, and dividends, the company's price tag. Market capitalization. This is the company's total price tag. It's what you would pay to buy the entire business. It's simple math. Take the current stock price and multiply it by the total number of shares available. Think of companies like different classes of fighter jets, mega cap. These are the established giants. Think Apple, Microsoft, Amazon, companies over $10 billion. They're stable, but offer limited growth potential. Small cap. These are the startups and young, fast-growing companies under $2 billion. They're like speedboats, high risk, but they can move fast and give you massive growth potential. Understanding market cap helps you manage risk. I learned this lesson the hard way when I put half my portfolio into a tiny cryptocurrency company, thinking it would make me rich overnight. The price-to-earnings ratio plus dividends, what you're paying for. This is one of the most important terms, the price-to-earnings ratio.
It answers a simple question. How much are you paying for every dollar of profit that company makes? You take the price of the stock and divide it by the company's annual earnings. If a stock has a PE of 20, it means investors are willing to pay $20 for every dollar the company earned. Lower P/E generally means it's a better value. A high PE means investors expect massive future growth. Remember to always compare PE within the same industry. I once bought a stock with a PE of 200 because I read one positive article and didn't understand what I was actually paying for. That company would have needed to grow profits by 2,000% just to justify its price. Guess how that worked out? Next up, dividends are your reward for owning the company. Picture it this way. The company makes a big pile of cash, and they send a little cash payment to you, the shareholder, typically every quarter. You get paid to just own the stock. My grandmother owned Coca-Cola stock for 40 years and used the dividend payments to take her grandkids on vacation every summer. She understood something I didn't learn until much later. Getting paid while you wait for the stock to grow is the ultimate win-win. Dividend yield measures that payment as a percentage of the stock price.
Earnings per share orders and 52-week high. Next is earnings per share, or EPS. This is the company's total profit divided by every share in existence. Why does this matter? Because a constantly growing EPS is the #1 fundamental driver of a stock's price. Companies can increase EPS through growth or by buying back their own shares, which reduces the total share count. Investors watch quarterly EPS reports closely to see if expectations are met or missed. Now protecting your money with orders. When you want to buy or sell a stock, two main ways. A market order, you're saying, I don't care about the price, buy it now. This guarantees speed, but the price might jump on you. A limit order, you're setting a boundary saying, only buy this stock if the price is $50 or lower. This guarantees your price, but it does not guarantee execution. For beginners, limit orders are generally safer. Finally, your financial seatbelt, the stop-loss order. You set a trigger price, say 10% below what you paid. If the stock price falls to that level, the order automatically sells your shares. It prevents a temporary drop from turning into a catastrophic loss. This is essential risk management. We also look at the 52-week high and low. This simply shows the highest and lowest prices a stock has traded over the last year. Trading near the high might suggest strong momentum, but also a possible overvaluation. Trading near the low might be a buying opportunity or a sign of deeper trouble.
Short selling options and beta. Advanced tactics. This is the ultimate confidence or arrogance play. Short selling is when you are literally betting a stock will go down. You borrow shares from your broker, immediately sell them, and hope the price falls so you can buy them back cheaper and return them. The profit is the difference. It's extremely risky because your potential losses are unlimited if the stock rises. I watched a friend try to short Tesla in 2020 because he thought it was overvalued. He was probably right about the valuation, but the stock kept climbing anyway. He lost more money than he'd ever made in the stock market because he bet against the market's momentum. Next, options. Think of options as buying insurance on a stock. You pay a small fee called a premium for the right to buy or sell a stock at a specific price before a certain date. Call options give you the right to buy stocks cheaply if they go up. Put options give you the right to sell stocks at a high price if they go down. Options trading provides leverage, but is complex and only for advanced investors. Finally, beta measures how much a stock's price moves relative to the overall market, helping investors understand volatility and risk levels. A beta of 1 means the stock moves exactly with the market. A beta above 1, like 1.5, is more volatile, rises 15% when the market rises 10%. A beta below 1 is less volatile and offers more stability. Beta helps you build a portfolio that matches your comfort level. You now know more about investing than 90% of casual investors. The biggest mistake is doing nothing out of fear. Start small, get comfortable, keep learning. The financial world tried to keep you out with complicated terminology, but you just broke through their barrier. Now use this knowledge to build the future you actually want. What's the one stock you're watching right now? Drop it in the comments and let's keep this conversation going. Your financial future starts with your next decision.